Hello and welcome to Stock Value Tips. Today we are looking at Merck Co, one of the world's leading pharmaceutical companies. Merck focuses primarily on human health, with a strong emphasis on oncology, vaccines, and specialty medicines. Its most important revenue driver is Keytruda, a leading cancer immunotherapy drug, which represents a significant portion of the company's total sales. In addition to oncology, Merck generates revenue from vaccines, including Gardasil, as well as treatments for infectious diseases and chronic conditions. Merck also operates an animal health segment, which provides veterinary pharmaceuticals and vaccines. While animal health is not the company's core business, it adds diversification and stable cash flow. Geographically, Merck generates the majority of its revenue in the United States, followed by international markets, making it a globally diversified pharmaceutical company. In this video, we'll break down Merck's business model, key risks, and long-term investment opportunities to see whether the stock looks attractive today. Let's now look at the key risks facing Merck today, ranked by their potential impact. The most significant risk is the upcoming patent expiration of Keytruda, which is rated 5 stars. Keytruda represents a large portion of Merck's total revenue, and its loss of exclusivity could materially impact future cash flows. Closely related is revenue concentration in oncology, which earns 4 stars. While oncology is a highly profitable segment, dependence on a single blockbuster drug increases risk. Another major concern is pipeline execution risk. Merck must successfully replace Keytruda revenue through new indications, next-generation oncology drugs, or acquisitions. Regulatory and pricing pressures also represent a 4-star risk, especially as governments and insurers push to control drug costs. Beyond Keytruda, Merck faces a broader patent cliff later in the decade, which adds further uncertainty to long-term growth. R&D productivity is a moderate risk, as drug development is inherently uncertain and expensive. Finally, while the animal health segment provides diversification, it is not a core growth driver for Merck, making it a lower-impact risk. Overall, Merck's future performance will depend heavily on how successfully it navigates the post-Keytruda era. Despite these risks, Merck also has several powerful long-term opportunities. The most important opportunity lies in its next-generation oncology pipeline. Merck is actively developing new cancer therapies and combination treatments designed to partially offset the eventual decline of Keytruda. In the near to medium term, Merck continues to expand Keytruda's life cycle through new indications and earlier-line treatments, helping to extend revenue durability. The animal health segment represents another attractive opportunity. This business provides stable growth, high margins, and diversification outside of human pharmaceuticals. Merck also benefits from a strong balance sheet and robust cash flow generation, giving the company flexibility to invest in research, acquisitions, or shareholder returns. Strategic acquisitions and partnerships remain a key lever for Merck to strengthen its pipeline and reduce dependency on a single product. Finally, long-term demographic trends, including an aging global population and rising cancer prevalence, support sustained demand for oncology treatments. Together, these factors suggest that while Merck faces meaningful challenges, it also has the tools and scale to navigate them successfully. Over the past 10 years, Merck delivered an average annual return of approximately 11.1%, including dividends and dividend reinvestment. This demonstrates a strong and consistent long-term performance for shareholders. From a valuation perspective, the stock currently trades at a price-to-earnings ratio of around 20.9. Its beta of 0.3 indicates very low volatility compared to the broader market. Merck trades at an EV to EBITDA multiple of approximately 9, supported by a strong balance sheet. Net debt to EBITDA stands at just 0.7, indicating easily manageable debt levels. Return on invested capital over the last 12 months is about 22.47%. In line with the company's historical levels and reflecting efficient capital allocation. The stock trades at a price-to-free cash flow multiple of around 20.2. Profitability remains a major strength. Net income margin stands at nearly 29.6%, which is close to historical highs. Gross margin is approximately 78% and has been steadily rising for the past 15 years. Overall, these metrics highlight Merck's strong financial quality, profitability, and balance sheet resilience. Merck currently pays an annual dividend of $3.19, with a payout ratio of approximately 42.6%. This leaves the company with significant flexibility to reinvest in research, acquisitions, and future growth. From an investment perspective, Merck has delivered strong long-term returns while maintaining low volatility and a resilient business model. The company benefits from industry-leading margins, a high return on invested capital, and a strong balance sheet with manageable debt levels. The main risk remains the long-term transition away from Keytruda, but Merck's pipeline, cash flow strength, and strategic flexibility position the company well to navigate this challenge. Thank you for watching. This video is for educational purposes only and is not investment advice. If you enjoyed the video, please leave a like, subscribe to the channel, and let us know in the comments. Do you own Merck shares today?